Thanks for your time today, Scott. So how should Brisbane investors take advantage of the mining boom?
Look, I think they should look carefully about where the people who are fly in, fly out type people are coming to Brisbane and buying. And that means that there are a lot of homeowners or a lot of fly in, fly out homeowners buying around in Brisbane, and we hear a lot of people wanting to buy in the inner northwest, probably out to about 10 k's, or southeast, that 10k radius there. So there seems to be a lot of demand for those people buying in those areas, and they have reasonably good access to the airport now with the road infrastructure. So I think those areas have great opportunities for investors with housing.
So does the same apply for rental demand?
Absolutely. I think rental demand, how we look at it, is we look at buying homes or properties in areas that have majority owner-occupiers in them. So you tend to get a better quality of neighbourhood, and then you tend to draw a better quality of tenant to that neighbourhood. So keeps your rental up, and also it makes capital growth a lot better, we feel, because owners are the ones with the needs and wants. The investors tend to be dollar driven, so don't go to typically where other investors go to.
Can you identify the suburbs that are experiencing this demand?
Sure, we tend to hear from people calling us that they want to come and live in the greener type areas, and that can mean anywhere from the Grange, Newmarket, stretching right around to Barden, Ashgrove, Toowong, Taringa, Injipilli, and then on to the south side of the river with Balmoral, Bulimba, Hawthorn, Norman Park, Camp Hill, Coorparoo. Those sort of areas are certainly very popular with buyers moving to Brisbane.
Scott, tell me about Brisbane's transport hubs, where they exist and where they're expanding.
Look, I think it's paramount for people to look at transport as a real driver for growth, because any city that you look at really around the world has to have good access to its city centre, or just generally to get around the city with public transport. So the areas that are identified in the South East Queensland Regional Plan are areas like Mount Gravatt, and all of these are within generally a 10 to 12k radius. Mount Gravatt to the south, Carindale to the east, Chermside to the north, and Injipilli to the west. So those areas have apartments and multi-res being built in them, and the density changes there have been changed in terms of height restrictions. So some of them have gone from 3 to 5 levels up to 10 levels. So there's certainly going to be a lot more people accommodated around those transport hubs. And then if you look at the areas, the transport routes coming into the Brisbane city centre, there's also a lot more development to be promoted around those routes. So low to medium density, you can see that a lot of those areas have been earmarked and zoned for that. And they'll typically be smaller complexes, but nonetheless important for investors to look at those. So the areas that would be identified as potential growth areas on the transport routes from those hubs into the city would be, say, suburbs into the north of Brisbane from Chermside, areas like Wavell Heights and Kedron, and then the areas to the south of Brisbane from Mount Gravatt, areas like Mount Gravatt East and Upper Mount Gravatt, Greenslopes, and then to the west, areas like Toowong, Taringa, and to the east, areas like Coorparoo, Camp Hill, all those areas that have what we call LMR, or low to medium density zonings. So some investors, if they want to buy and hold for the long term, get long term growth, should look at buying some of those LMR sites, and they might have a house on it, a post-war home that they can obviously get a rental return on and hold. They don't have to develop it. It might be something that they just buy and hold and sell on to a developer in years to come.
Tell me about Brisbane's household configuration change and how investors are changing the way that they're selecting their investments.
We've identified in terms of the fastest growing demographics. Bernard Salt put out some statistics a while ago that the single households and double household, no children, are the fastest growing demographics. That's not to say that the families aren't still growth there, but we're finding that developments are being targeted around those single households and double households because of the growth. And I think that's something that investors should also look at when looking to buy investment properties, but they should look at smaller complexes, because we've found in our research that owners tend to buy in the smaller complexes where investors tend to buy in the larger complexes. So you really, again, want to buy where the owners are buying because of the capital growth scenario. So we found that the best capital growth come from those smaller complexes, 2-bedroom, 2-bathroom, 3-bedroom, 2-bathroom, even the 1-bedroom, 1-bathroom, so long as it's in a well-located, good complex, what we call lifestyle precincts, where there's cafes, restaurants and parks and that sort of thing, good access to transport. As far as the under $500,000 market goes, there's plenty of choice for actual properties within the 5 or 6K radius, unit market that is. Plenty of choice out there. Whether there's plenty of stock on the market at any one time, that's another thing. But certainly we, as a buyer's agency, have bought properties between that 400 to 450, 2-bedroom, 2-bathroom, small complex, well located properties close to transport, lifestyle precinct, in areas inner west, Auckland Flower, Toowong, those sort of things. And I really think that those small complexes and those areas in particular have good prospects for capital growth.
Wonderful. Thanks for your time today, Scott.